Hello everybody, Ray Halstead and Andrew McMillan here with REH CPA. Today we want to talk about the accumulated earnings tax. I know a lot of you who have C corporations are familiar with the problem of double taxation with those type of structures. Where to get money out, you either got to take it through a W-2 wage, which is taxed at your personal level, or take dividends, which is taxed at your personal level as well. So you get hit with that double taxation. But something that a lot of C Corp owners aren't familiar with is that accumulated earnings tax. Andrew McMillan is going to help us today get a better understanding of what that is. Andrew?
So there's a third tax, like you said, that you have to be aware of. It's called the accumulated earnings tax. And what it is it's a 20% penalty on the corporation for accumulating earnings in excess of $250,000. So essentially you've got cash in the bank that exceeds $250,000 that has been building up year over year, and you haven't paid it out through either payroll or dividends to the shareholders. The IRS could assess this tax to you. So it is a tax that comes up under an audit. It's not anything that's calculated on the tax return. It comes up under an IRS audit, but it is a 20% penalty level. It's a penalty tax on the C Corp for an accumulation of earnings.
So how does a corporation guard itself against that 20% penalty?
Yeah, so it's good to be proactive about it. You certainly can accumulate earnings if it's going to be used for some justifiable event. So you want to make sure that you have meetings about why you're accumulating these earnings. You want to have a budget in place. You want to have those meetings recorded in the minutes, in the books, in the minutes of the board minutes every month. You want just show a plan as to why you are accumulating these earnings, because it certainly is allowable, but you do need to be able to justify why you're accumulating these earnings, and you have chosen not to pay them out through dividends.
Right, because the IRS wants their money.
Correct. Like the IRS, you can't just say, well, we just didn't want to. We wanted to avoid shareholder dividends. Well, that's not a good answer.
Right.
So, it is important to note that this $250,000 threshold is pretty outdated. It was born out of the tax law of 1981.
Yeah, I think it's been $250 since I was in college.
Yep, it has not been adjusted for inflation or anything since 1981. So I think in today's dollars, that $250K is close to $775,000. So, it's just something the IRS hasn't addressed it yet. So unfortunately, that's still the rule. So our recommendation to clients is just to be aware of the rule. And if you are accumulating those earnings, just make sure you're talking about it with your shareholders, and you're documenting the meetings and the board minutes. Designate the earnings in a different account on your financial statements, appropriate them for what they're going to need to be used for. Those are all ways to safeguard yourself if it ever comes up into question in an audit.
Awesome. So if you have a C corporation and you have questions about the accumulated earnings tax and you'd like to talk to one of our CPAs about it, feel free to give us a call or send us an email and set up an appointment. We really appreciate it. Thanks.